Through the years, our team at TAPCO has heard a few myths about how to build or improve your credit. Some are a little more interesting than others.
Your score will go down if you ask for your credit report, so don't do it.
Always keep a 30 to 50% balance on your credit cards because that way you look profitable to a creditor.
Just keep rolling your balances onto new credit cards with 0% introductory rates.
If you really want to boost your score, just close all of your unused credit cards.
Just marry someone with great credit. You'll be all set.
Time to dispel some myths on how to build or improve your credit. In this video, my colleague Elizabeth and I are going to share 3 points about this. The first, what is the difference between your credit report and your credit score? Second, how exactly is your credit score determined? And third, 3 tips on how to improve your score. So first, let's start with what's the difference between a credit report and a credit score. Your credit report is your credit history, and that's provided by the 3 credit bureaus, Experian, Equifax, and TransUnion. Your credit score is provided by a different company. That's usually FICO, Fair Isaac Corporation. When a lender pulls your credit, we access your credit report, say from Experian, and then the FICO scoring model is applied to it. And you may be wondering, how come I have 3 different credit scores then if the bureaus aren't scoring my data? The reason why they can be different is because some lenders will report only to one of the 3 bureaus, so they have different information about you. So when the same scoring model is applied to the 3 credit bureaus, that's how you get 3 different credit scores. Now, Elizabeth is going to share with us the 5 primary factors for how your credit score is determined.
Before we talk about credit factors, scores range from 300 to 850. However, nobody really gets 850. Typically, A+ credit is 730 or higher. Credit is kind of like the teacher that doesn't want to give the perfect A. There's always room for improvement. Factor number 1 is payment history. This accounts for 35% of your credit score. Just make your payments on time. This is the number 1 thing. If your payment is not there by the due date, you could get a late fee, or for credit cards, they might possibly lower the limit. If you are 30 days late, it'll get reported to the credit bureau and your score will drop significantly. So just really important, make it there by the due date. 30% of your score is amounts owed. For credit cards and line of credit, keep your balances low. That way we avoid paying too much interest. And also it will appear as though we still have some credit available. The next 15% of your score is determined by length of history. The longer an account is open, the better for your score because it establishes a history with that particular creditor. So be selective when you close an account. You don't want to close one that you've had open for a really long time. 10% of your score comes from your mix of credit. Auto loans, mortgages, personal loans, those are considered closed-end installment loans versus credit cards and lines of credit, those are considered revolving. So it's really important to have both types of credit on your bureau. However, installment loans or closed-end loans actually score a little bit higher. The last factor of your score comes from credit inquiries. You want to use credit sparingly because each time you apply for credit, it actually lowers your score. Those are the 5 factors that make up your credit score. I know that was a lot of information, so Jeremy is going to help incorporate that into a few tips that will help either rebuild or establish your credit.
When I'm counseling our members on how to either build or improve their credit score, I always start with those first 5 factors, and then number 1 and most important being their payment history. So if we're reviewing a credit report and we have maybe some delinquencies or if there's an unpaid collections, I always start with let's bring those accounts current and let's pay off that unpaid collections. This is not going to increase your credit score overnight, but it does help establish good payment history moving forward and help you build strong credit. Now, even if you have strong payment history, you want to make sure that you're regularly checking in on your credit report, making sure the information is accurate. You can do this through annualcreditreport.com and access all 3 bureaus one time each year for free. The second tip that I have for borrowers that are looking to improve their credit score is where we start talking about personal finance. Oftentimes when I see a borrower with multiple late payments on their credit bureau, it's because they have many different credit cards, maybe 7, 8, even 9 different cards. And that can be a lot to keep track of. And that's where we really want to start talking about consolidating those balances into fewer cards, and we need to be strategic about it. We don't want to close your oldest credit card because that's your length of history. And it's also important to think about how to diversify your credit. It's really strong to have 2 or 3 different credit cards on your bureau, but it's also really nice to have an installment loan. So doing a debt consolidation loan to an installment loan also helps you build credit and reduce your overall credit card balances. My final tip for helping to improve your credit score also has the quickest short-term impact, which is the relationship of your credit card balances to the credit card limits. Now, the industry jargon for this is the utilization ratio, and we want to keep that ratio as low as possible because the lower that it is, the higher your credit score will be. A good rule of thumb is to keep your balances at less than 25% of the overall limits. A great credit score is possible no matter what your personal starting point is, whether you're looking to build credit for the first time or improve your credit score. With a good strategy and steady effort, you will be well on your way to happier banking.